what we really are trying to do for our clients is give them three things that they all ask for, but they ask for them in different ways. They ask for freedom, peace, and joy. Now, in the context of finance, freedom is often financial freedom. Now, many of our clients have financial freedom or quickly get there through their industriousness. So then it becomes a question of how do I keep this? How do I not lose all this wealth so that I have something that my spouse and I can count on forever and we can get something out of the kids and the grandkids and build a legacy. So we take advice that was, given by Solomon 3,000 years ago, which is, hold your merchandise in 7 or 8 investments, for you know not what the earth shall bring. So we're very open-minded to different asset classes and different categories. This is especially important now because stocks and bonds, which typically were opposed from a correlation standpoint, have really been highly correlated for the last decade. Now you could debate why that is. Perhaps quantitative easing had a big role in that. And maybe we're getting to a normal position where, when stocks go up, bonds go down and vice versa, like it used to be. But we haven't quite gotten there yet. So we've been using alternative assets in our client portfolios for years. Now you'll hear of phrases like private equity, private credit, private real estate, various forms of alternatives, real assets. And sort of the more the merrier there if you can get good, safe underwriting on the assets that don't correlate. We even have clients that have limited partnership interests in oil and gas drilling operations. Now, why would they do that? Because oil doesn't correlate with the S&P 500. It doesn't move with Nvidia. It moves to the whims and desires of 4 countries: Saudi Arabia, Iran, the US, and the Soviet and Russia. And so that's a good correlator. And if you can get that 40, $60 a barrel, now it's higher, you can get good performance and excellent tax advantages through oil. So how does that work with blockchain? Well, most people that I deal with have no idea how the blockchain works. In fact, the industry really has no idea how the blockchain works, I would say. It's so new and it's changing rapidly. And the conversations I have are generally centered around smart contracts in the future, but Bitcoin now. Now, Bitcoin is it's a polarizing subject, and I don't know where Bitcoin's going. To me, Bitcoin is a little bit like gold in the sense that it doesn't produce capital. It's an appreciating or depreciating asset, much like a Van Gogh painting or a vintage Ferrari. So it's valuable as long as there's a market for the value, but it doesn't yet produce capital. Now, where I think a good entry point into the digital currency marketplace is stablecoin, because what investors that have a lot of wealth want is they want to understand how to diversify their assets, but also they don't want to be left at the train station if digital assets become very important to the economy. And where I see stablecoin is a bridge between the U.S. Treasury and the digital marketplace. And it's sort of an on-ramp, in my opinion. Now, there's a whole lot of things that have to get worked out, and the underwriting of the assets is all evolving. But it, to me, sounds like a very interesting way to get your feet wet with owning an asset that's digital and adding something that's complementary to your portfolio and doesn't act like everything else.
Yeah, that's an incredible breakdown. And I think just to double click on some of what you mentioned, for
Mhm,
most people, and I was at NYU yesterday, we were just interviewing students and like recent
mhm,
grads, and it's a whole nother very different demographic, but weirdly a lot of
mhm,
parallels with what you described.
mhm,
Like most students, if they had any crypto at all or had any excitement about blockchains,
mhm,
it was maybe Bitcoin, and then people had heard of stable coins, and it
mhm,
was not an immediate like, oh, this is sketch, this is scary.
mhm,
And it is like some sort of entry point. I think the question now is what can you do with it? And of course,
mhm,
we're very biased, and you coming on as an advisor and learning more about it, Axel,
mhm,
I think know more than 99% of people of like stablecoin lending markets. I think
mhm,
classifying these as like today an alternative, similar to how people view private credit and like who's underwriting these types of things. is not too
Mhm.
terrible. Like these are over collateralized loans, but there is
Mhm.
smart contract risk. There is trust in platforms today, and code is supposed to be law, but it's a sliding scale on how much the code governs versus people. So I guess
Mhm.
what do you view as key gaps or jumping points almost when you're discussing with clients or just people who aren't in the crypto bubble for like getting them over the hump to something like stablecoin lending, where these are just marketplaces. People want to go and borrow. There is an interest rate that's paid back. Code is governing these markets. Like,
Mhm.
how do you describe it? And then I can also talk more about how I described it to kids
Mhm.
and what resonated with them. But I think that's particularly interesting to us and our viewership.
Well, for 2026, I think a safe way to play this market is look at it as a new asset and look at it as a small part of your overall portfolio. So keep the percentages low so that you can learn and experience it firsthand without taking too much portfolio risk. Because we don't, with new things, I like to proceed with caution. So I think it's a very good idea to get a little bit of money into this asset class. Now, what when you deal with some of the assets we obtain for our clients, you need to be a qualified investor, which means you have to have significant capital already. And you need to have an advisor, which means you have to have a professional relationship and a way into that community. For people that don't have significant capital and don't have a professional advisor, but want to learn what this digital world is like, this is a great on-ramp. Put a little bit of money in, you can go online, it's a retail experience, you don't need an advisor, and you can see with your own two eyes how the asset performs over time. And then as your confidence level grows with the returns and your education level grows with the asset, and as the regulatory environment evolves, you can begin to add more and to your portfolio on a percentage basis, but also broaden the types of assets you own within the digital world. I mean, I was blown away, Ash, when you were meeting at the Fed.
Yeah.
What I
Chicago, I
don't know
think
if
it
it
was
was,
the Hester
yeah, it was
Pierce.
last month.
Yeah, Hester
Uh,
Pierce from the SEC. People call her like crypto mom. She's the most crypto forward. But and now you got Chairman Atkins as well. Like that whole commission's crazy right now.
yeah, I mean, I was reading the articles about you meeting with the crypto mom, and that was very interesting that the US federal government thinks this is an asset class that they need to know very well. And I think it's because it's an on-ramp and off-ramp to the US Treasury.
Yeah. I fully
And,
agree. And
and that's where
especially
they
in
see the
the
vision.
yeah. Really quick, and then I know Ari has a ton of thoughts. Just for my knowledge, like what is that current breakdown? Take your average client. So of course, this is not necessarily like retail or a college kid. What
Mhm.
is the rough portfolio composition today across different asset classes? I'm assuming there's a ton of bonds. There's maybe
Mhm.
some index funds like the S&P or
Mhm.
QQQ, like maybe some private credit, maybe alts or more tech forward things for folks that are more tech forward. Just
Mhm.
what is that breakdown?
So I'm going to give this as with my normal disclaimer. All of the portfolios that we build for clients are custom, and they're recommended after a very comprehensive plan so that we understand the risks and exposures they have in other parts of their life, and we can build a complementary portfolio. Now, that said, in general circles, you've heard the expression 60/40 and rebalance automatically. So what does that mean? That's a pretty solid approach to someone who's never really invested. 60% of your retirement funds into equities and 40% into fixed income. They'll balance each other out, and then you just can set it to auto rebalance. So if I was someone in the middle of my working career, I think that's a very sound approach for retirement assets, as an example. If you're younger, maybe 80/20. If you're older, maybe 40/60. But what we're finding is that the equity markets now, with price earnings ratios are frothy, right? They're quite high, and they're driven by a very few number of companies, 7 or 10 companies at very high multiples. So if you think, geez, maybe we're at the tail end of this bull market on equities, the last 10 years, it's arguable, and very highly respected pundits have said the last 10 years in the equity markets may not be matched in the next 10 years, right? But they've even gone on to say the bond markets, which were grossly underperformed the equity markets in the last 10 years, might actually outperform the equity markets in the next 10 years. So, and these are very, these are very respected pundits that are proposing this might be a solution. Now, whether that happens, time will tell. But what we've been doing is we've been doing a four sort of at the simplest level, four asset classes. We've got equities, fixed income, alternatives, and cash. Now, alternatives, you need to be very careful when you go to alternatives and understand the concept of liquidity because some alternatives that are marketed, like private credit's been in the news. Jamie Dimon made some comments which have been, I think, a little bit misinterpreted about private credit because JP Morgan has some excellent private credit offerings. Um, but his point, I think, was if you don't underwrite the private credit properly, you're going to get your clients into trouble because there will be defaults in certain private markets. So if you want to have some alternative exposure, but you're not yet a qualified investor, you can't get into private credit, you can't get into private equity, you can't get into all these other unique and esoteric forms that we provide for high net worth clients. This is actually an alternative asset class that you could dabble in and give you some non-correlated protection against your equities and your fixed income.
I have one and it's building off of that. But how is that portfolio changing? You already so we have all these like macroeconomic factors like frothiness, P ratios, technology, geopolitics. Like what does it look like in 5 to 10 years? Or are these just kind of timeless principles? How do you see that?
Well, so what's the old joke in Wall Street? The greatest lie is that things are different now,
Right, right.
right? So if you have the hubris to or the humility to say, I think there's an inverse relationship between the degree of confidence you have in the future and your experience and expertise with regards to that subject. So we, I don't know what the next 10 years are going to look like. So we do our best to position. It's kind of like you're on a surfboard in the middle of the ocean. You don't know when the big wave's coming. You don't know when the little wave's coming. You don't know when the set of three choppy waves are coming. You just need to be on a decent surfboard that you know how to use and ride the wave and understand where the reefs are so that you can enjoy yourself. And I think if you can diversify um, and pay attention and rebalance, that's what the textbooks tell us. Spread the wealth around to different asset classes, pay attention, diversify, and be tax smart. So I think this is where stable coins to me is an interesting consideration from the point of diversification, its yield, and I don't know what the future is going to hold on the equity markets. I'm more confident that the bond markets will be more predictable in the next 10 years than the equity markets.
That's well said. Final thing on my end, and it goes a little bit more forward looking, but also extremely tangible. Like, of course, Axel is live right now. It has an app that people can use, super retail friendly. Anyone with $2 can go and deposit, but we also have users that have put in millions. Our own treasuries in it, like all of Ari and I's salaries and livelihood is just tied into the product that it's earning, which is also just a good philosophy that we believe in. What do you see as like when you think about it from that perspective? Like, imagine you got a friend or family member, or just like a younger person that's more excited about adding this on, what do they need to see? And of course, in our own user interviews, some things have come up more than others, like insurance and like what the hell is DeFi lending? What is DeFi? Like what is a stable coin? Like how does this differ from like the balance I see on my Chase bank account where it's not cash, but I know it's dollars? Like there's all of that.
Yeah.
Like what in your mind is like the big unlock for us to maybe have a bigger kind of everybody can go and use this and this makes sense to seriously think of as an alt?
Yeah. I think the main attractive quality right now is twofold. One is yield and diversification,
Mhm.
right? And you've made that pretty clear on the website and you're providing attractive yields for people. Then the on the opposite side, there's risk. There's risk because it's novel, right? It's new, and there's it's code that backs up the asset class. So there's risk on the technical side too. So that's why I would caution against overexposure to the asset class unless you are deeply involved as a professional. So if you're a retail investor, I would say start slow, understand the asset class, understand what the risks are, the downside risks